So everybody's talking about depreciation. They're super excited about being a real estate professional or having some short-term rentals so that you can get this huge depreciation. But what they're not talking about is what happens when you sell that property. And this goes with anything, whether it's a rental or a car or any piece of equipment. When you sell that piece of equipment, you're basically gonna undo the deduction that you got for the amount that you sell it for. So I think it's easiest to talk about a car, especially if it qualifies for bonus depreciation, which is 100% again. If you buy a $50,000 car and you spend $50,000 to get it, in other words, you don't finance it, the IRS is going to give you a $50,000 deduction, assuming it qualifies for 100% bonus depreciation, which is going to save you about $11,000 if you're in the 22% tax bracket, right? So you spent $50,000 to get $11,000. So why is that such great advice? It's because most people don't actually put the full $50,000 down. So your accountant is going to tell you to buy it on, December 31st, and you're going to put $0 down. And that way, $0 left your bank account, but you still got an $11,000 savings. But what they don't tell you is now when you make the payments to the bank on that $50,000, the principal portion, which eventually will add up to $50,000, is not deductible because you already took that deduction, right? And so it all kind of evens out in the end. It's a timing difference. And that's really where the game is played. Now that doesn't mean that it can't be very beneficial and we don't want to play the game. We do want to play that game when it is beneficial in the long term. And what makes the biggest difference between a vehicle or a piece of equipment and a house, for instance, is that generally speaking, houses are going to go up in value, even though you get the deduction through depreciation. With vehicles and equipment, most equipment, almost everything else, it's actually going to go down in value. So it's not really a wise investment, even if it does save you a lot in taxes at the beginning. So assuming the piece of equipment qualifies for 100% bonus depreciation or 179 deduction, you're going to get the savings this year, regardless of how much money you put down on the piece of equipment. But when you sell that piece of equipment, let's say you were doing something just for the tax savings. If you bought a $50,000 car that qualified for 100% bonus depreciation on December 31st, but then on January 1st, you sold that car, but since you bought it, now it's only worth $4,500 or $45,000, right? Because that's how quickly cars can depreciate. So you're basically going to say, okay, I got a $50,000 deduction, but now I have to recapture $45,000 of that on next year. So that's what it does in the long term, regardless of whether it's a day later, 10 years later. So buying something just for the sake of it being a tax deduction is never good advice, never going to be beneficial in the long run, unless that thing that you're buying is actually going up in value. And very few things are going to do that. The depreciation recapture is when you sell that thing that you've already depreciated. And the time that it comes back to bite people more than anything else is with rentals. Because so for simple math purposes, let's pretend that you purchased a $400,000 rental. The land is worth $100,000. You can't depreciate land, so the depreciable basis is $300,000. And normally you would depreciate this over 27 and a half years, but just for simple math, let's pretend it's 30 years, okay? So the IRS doesn't care what your mortgage payment is. I hear that all the time. People say, well, I'm renting it out for the exact amount that I'm paying my mortgage payment is, and so it's a break even, I'm not making any money. Well, actually you might be, because the IRS does not care what that payment is. What they care about is, the IRS doesn't care about the principal portion of the payment. You can always deduct the interest, but the principal portion they don't care about. So you still might have a tax taxable income. So again, with my example, $300,000 house depreciated over 30 years is $10,000 a year. They don't care if you're paying $20,000 in your payments, they're gonna give you a $10,000 per year deduction for the next 30 years, even if you pay it off early. And you pay it off in 20 years or 10 years, they're not giving you extra deductions for your payment. Does that make sense? So let's say that you've kept this rental for 10 years. You've now depreciated it $100,000, $10,000 a year, right? So now your basis in the property is $200,000. But the property has actually gone up in value. It's now worth, you bought it for $400,000 including the land. Now it's worth $500,000. So in the year that you sell it, you have depreciation recapture of $100,000 plus you have another $100,000 capital gain that you have to pay taxes on, regardless of how much you still owe to the bank. Like if you refinanced it and you still owe $400,000 to the bank, you're gonna sell it for $500,000, but you're still gonna pay taxes on $200,000, not on $100,000. So that is where depreciation recapture really takes people by surprise, and where it comes into play the most is with rentals. There's one way to avoid depreciation recapture for good, and that is to die. If you die, you don't have to pay it, but for real, if you die, your kids or beneficiaries, whoever they are, get a step up in basis. Basically, they get to pretend like they bought the property for whatever it's worth on the day that you died. So let's say you kept the rental for 30 years, the full 30 years, or 50 years, right? You've already fully depreciated it and then some. But now it's worth $650,000 and you give it to your kids. Now your kids are gonna get it and they get it at $650,000. They get to pretend like they bought it at $650,000. And if they keep it, they get to depreciate it now over 27 and a half years. Or they sell it, and they sell it for $650,000 because that's what it's worth, and their basis is $650,000, so they pay taxes on $0. That is the only way to truly avoid depreciation recapture. And that's true with a rental or with any other equipment, but rental's where it comes into play the most because, again, that's the asset that actually goes up in value over time, generally speaking, instead of down in value like almost all other equipment that you're going to buy for your business. The other one that comes up, and the reason why I was going back and forth between 1 and 2 ways to avoid depreciation recapture, is because there's the 1031 exchange that people hear about. Now, the most important thing to know about a 1031 exchange is you can't do it by yourself. I hear that all the time. They're like, I sold this rental, but then I bought another one just 30 days later, and so I want you to do a 1031 exchange. Well, if you're coming to me with that, it's already too late. For a 1031 to exchange actually work, let me say that better. For a 1031 exchange to actually work, you have to hire the intermediary business before you sell and before you buy your new rental. And they're going to charge you generally like between $1,000 and $3,000 depending on the type of property that it is. If it's just a simple residence, if it's a hotel or an apartment complex, I'm sure it costs more, but I digress. So then that is a way not to avoid depreciation recapture, but to delay it. And that delays, and that doing a 1031 exchange doesn't give you additional depreciation. If you bought the property, in my house example where you bought it for $300,000, but now it's worth $500,000, but your basis is $200,000. It's hard for people. Maybe that's too hard for people to follow, but anyways. In that example, if you then sold it, because it's worth $500,000, you would have to buy a house that is also worth $500,000. You can't just buy one that was worth $300,000 and pocket the $200,000 difference. You have to buy one that is $500,000. And then you still are only going to depreciate the remaining $200,000. So you basically, that's what a 1031 exchange is you basically pretend like you never sold the property. You don't get additional depreciation for it. It just delays what was already going to happen on the first property. So the only reason to do it is if you want to stay in the rental business, but you just don't want that rental anymore. And you don't want the tax consequence of selling it and then buying a new one, because there would be a tax consequence. So this just avoids the tax consequence until you then sold the next property. But you can do a 1031 exchange over and over and over again, and then you die and your beneficiaries inherit it and they get a step up in basis. So that's why there's only one way to undo depreciation recapture or avoid it completely. And the second way is just delaying it with the 1031. So you're going to want your CPA to know, does it qualify for bonus depreciation? How much is this actually going to save me in taxes? What's my tax bracket now? If I take bonus depreciation of $50,000, do I get it all in the 37% tax bracket, or does it lower me down to a smaller tax bracket? Like, am I right on the verge? So you want to ask them, how much is it actually going to save me in taxes? And then you can make a more informed decision as to how much, if any, you want to finance. Because in the long run, you're going to pay more money financing it. Even though the interest is taxed up, you're still going to pay more money financing it. So you want to know how much is it actually going to save me, and which isn't eligible for bonus depreciation or 179 and tax bracket. And then the taxpayer can make a more educated, more informed decision as to whether or not they want to finance it.